Hello everyone, I am Rahul sir, your management educator. Today we are going to discuss the most important topic of financial management capital structure theories. Okay, as you know, we have discussed four topics till now. That is our CAPM APT model of portfolio management. Then earlier we discussed the dividend theories, working capital management, and the capital budgeting and introduction to financial management. These videos are already covered. They are available in this UGC Net Management crash course. If you search name playlist is the playlist name, here you will search, you will get all these videos. Okay, so we are starting with the capital structure theories. It's 101% guaranteed topic that the question will be asked from this topic. UGC as the UGC NET exam is very close, we are offering the paper 2 management course. If you take this course, you will get complete video lectures, full syllabus notes, test series, and PYQ PDFs. This is going to be a target based preparation. The biggest advantage of this course is paper 2 is 2 course. If you take, you will get paper 1 totally free. No extra money will be charged for paper 1. The fees of this course is 7,000 rupees and the validity is 1 year. Okay, so here is all the content we have provided. You can buy the course and take all the advantage of the content provided, because this is the right time to take the course, because a very less time is left for the examination. So this is our official app. You have to download it. Then after logging in, you will see this home interface. In this home interface, you can get the store. You will get the store button at the second left corner. On which if you click here, they will show the search bar. There you can type UGC NET Paper 2 Management, or just select this course, UGC NET Paper 2 Management. You have to select it, and after paying, you can access the content. If you want to join the batch, contact on the given number, and if you have any queries regarding the batch, you can contact him. Okay. So in our today's lecture, we are going to discuss what is capital structure, then what is the importance of capital structure, optimal capital structure, then theories of capital structure, in which we are going to discuss net income approach, net operating income approach, then traditional approach, and Modigliani-Miller approach. These sometimes these are called as theories and sometimes these are called as approaches. So don't get confused. So let's discuss what is capital structure. Capital structure is the particular combination of debt and equity used by a company to finance its overall operation and growth. Basically, capital structure is what? It is subjected to the financing decision of the three elements of the financial management. It is subjected to the financing decision. Here we bring the funds from different long-term sources and prepare a structure which will maximize, which will give us a benefit and maximize the value of the firm at a lowest cost. Okay, so capital structure is also called as capital mix. So don't get confused if capital mix is mentioned in exam. Then capital structure of the company refers to the composition or capitalization of the costs. Okay, there are different costs like KD, cost of debt, cost of equity, cost of retained earning, cost of preference share. So these are the multiple costs which we have to take care of while planning our capital structure. Then it is related to the financing decision. We have discussed this, and this company uses the long-term financial sources only. This no short-term source will be used. It will use the long-term sources of funds only. Just a second. Sorry for that inconvenience. Let's understand the difference between the capital structure and financial structure. This difference is very much important from the exam point of view, because sometimes they may confuse by formulating the statement type question. So in case of financial structure, it includes both the long-term and short-term sources of funds. Financial structure tells the overall is the overall structure, but the capital structure is subject only uses the long-term sources of funds. Okay, then financial structure means the entire liability side of the balance sheet. Entire liability side of the balance sheet is termed under the financial structure. All the current and the non-current liabilities will be covered under this financial structure. But in case of capital structure, only the long-term liabilities of the company. Then we have financial structures consist of all the sources of capital. Financial structure includes all sources of finance, either short term or long term. But the capital structure sources, it consists of equity, preference share, retained earning, and debt capital. Okay, then it will not be more important while determining the value of firm. Financial structure has less role in determining the value of the firm, but the capital structure, it's the one of major it plays a major role while determining the value of the firm. Okay, I hope this is clear. Then what is optimal capital structure? Optimal capital structure is the ratio of the optimal capital is 2:1. Okay, where 2% is of the debt and 1% is the equity. Here it is the situation where the weighted average cost of capital, means the WACC, is the lowest and the value of the firm is highest. Okay, then it is the position where the earning per share is the highest. The rate at which the EPS will be high, or the KO, that is the overall cost of capital, will be low, and the value will be the high. So this, at this condition, we will say that we will using the optimal capital structure. Okay. So I hope you know, you are aware to the chart. What is this? This is the earning before income, depreciation, interest and tax. Then here we reduce the depreciation, we get EBIT. Then after reducing interest, we get EBT. And then after reducing the tax, we can get the EAT, earning after tax. And after, when this earning after tax is divided by number of shareholders, we get the EPS, earning per share. I hope this is clear. I told this because sometimes and nowadays NTA is asking sequence based question, so it will be help. They might ask what arrange the following in terms of deductions while determining the earning per share. So this question came in my mind, and that's why I told you this. Okay. Then what are the attributes of a planned capital structure? A planned capital structure has the following attributes, like maximum return on investment. A capital structure will be planned in such a way that the investment, whatever we do, it will give a maximum return. Then flexibility. Capital structure should not be rigid. Some flexibility should be there, so that if any external or internal situation changes, we can modify it. Okay. Then debt capacity should not be high. The capacity of the debt should not be high, because if by using too large amount of debt, there is a risk of insolvency. Okay. Then low risk. The capital structure is should be less risky, because we have to use it for long term. Okay. Then risk of the dilution of control should be reduced. The dilution of control means there should be control. It should not happen that the external financer who is offering debt to us is controlling our firm. So the control should be diluted. And the no flotation cost. There is no flotation cost in the plan optimal capital structure. Okay. Flotation cost means the cost incurred while issuing the share. So let's discuss what are the capital structure theory. It's the most important part of today's class. That capital structure theories, we have two types of theories, that is relevancy theories and irrelevancy theories. Relevancy theories states that the capital structure affects the value of the firm, and the irrelevancy theory states that the capital structure does not affect the value of the firm. In case of relevant theories, we have two theories: net income theory and traditional theory. These are the two theories which we study in relevant theories. Then in case of the irrelevancy, we study the net operating income and Modigliani Miller approach. Okay? I hope this is clear, because this type of classification based question can be asked. Let's understand the first one, that is net income approach. It was given by David Durand. Remember this? David Durand was the pioneer of this net income approach, and he has also given the next approach, that is net operating income. Okay, it is relevancy impact on the value of the firm. The capital structure impacts the value of the firm. It's the main motto. If debt is used in the it's written twice. If debt is used in the company, its capital structure, in its capital structure, the firm will increase the value and the cost of capital will decrease. It simply means that the it says that the net income approach is very most simplest. Here it tells that if we use the debt, our value of the firm will enhance and the cost of capital will be low. Why? Because debt is the cheapest force of finance. I hope you might have understood. I have mentioned each point in very crux form because it's the time to remember, is the time to understand the points, point to point, because if you understand and point to point, it will be easy for you to mark the correct answer, to choose the correct answer in option. So these are the assumptions. Assumptions are most important from the exam point of view, because assumption based questions are asked in large numbers. The cost of debt is less than cost of equity, then there are no corporate taxes, then firm's capital requirement remains constant, the capital requirement of the firm remains constant, then risk perception is not affected by usage of debt. Even though company is bringing a lot of debt, but the risk perception of the equity shareholders will not be affected as per this theory. This is the assumption of this theory. Then fifth one, higher the degree of leverage leads to higher the value of the firm. That means that the greater the debt you use, the firm will the value of the firm will enhance proportionately. The debt, the leverage and the value of the firm has a direct relation. It simply states that the value of the firm will enhance by using more debt, and at the same time the cost of capital will decrease. This is the main crux of the net income theory. Remember these assumptions. I am repeating once again. Cost of debt is less than cost of equity, then there will be no taxes. This is the most common assumption in everywhere in capital structure, all theories, and in case of dividend theories too. Then the firm's capital requirements will remain constant. The capital requirement will remain constant. Then risk perception will not be affected by usage of debt, and higher the degree of leverage leads to higher value of the firm. Here you are seeing the diagram, that in this diagram, on the x-axis they have mentioned the debt, and on the y-axis they have mentioned the cost of capital. Here the amount of debt, the cost of equity is constant. Here in this diagram, the cost of equity is constant. As the debt proportion is rising in the capital structure, the cost of capital is reducing. Okay. Let's understand the net operating income approach. It was also given by David Durand. It is purely opposite to net income approach. This net income approach was given by the same person, but it is opposite to net income approach. It is irrelevancy theory. This theory is irrelevancy theory, as we seen earlier in the chart. Then value is independent of capital structure. The firm's value is independent of this capital structure. This fellow was once earlier, he had no drinks, so he said capital structure follows affects the value of the firm, but after drinking he said capital structure has no impact on the value of the firm. jokes apart, I am just telling, because same person is giving two different purely opposite conclusions. Then, well, what affects the market? He also said that the value of firm will not be affected by the capital structure, but it will be affected by the market trends. What are the trends are going in the market? They may affect the value of the firm. Then fifth point is the use of less costly debt leads to risk for equity shareholders and increase the cost of equity. Here he said one more point. In the previous theory, here he gave an assumption that the risk perception was not affected by the usage of debt, this fourth one. But now here he says that if you use the debt in the higher, if you use the less costly debt, it will increase the risk for the equity shareholders, and the cost of the equity will high, because they will ask for the more dividends, because they may feel risk that the firm may dissolve in the future if it does not pay the debt on time. Then the financial risk will be high if the debt proportion will be high. It simply means that the financial risk will be high and the debt proportion will be high. Let's understand the assumptions. The assumptions are quite similar, that the business risk is constant, then no corporate tax, debt capitalization rate remains constant, and the cost of cost of equity KE increases with the leverage and eats the advantage of low cost debts. Here what it's saying, that the value of if the usage of debt rises, then it will lead to increase in the cost of capital, and the advantage that debt is the cheapest sources of finance, that advantage it will vanish it out. I hope this is clear. So if you see this diagram, on the x-axis, the leverage is given, that is the debt proportion, it is constant, and the cost of capital is mentioned on the y-axis. Here, if the proportion, if the debt rises, then the cost of equity will increase. So that was all about the net income approach. Now let's see traditional theory. Traditional theory was given by Ezra Solomon. It is an intermediate approach. This talks about from both the sides, from the net income and net operating income. That's why it is called as the intermediate approach. Okay. If it asks in exam which of the following approaches of capital structure is termed as the intermediate, so tick mark the traditional approach, because it has both the features of net income and net operating income. It is not MET, it is net operating income. Okay. Net income and net operating income approach. Then it is uses the justifiable mix of debt and equity. It tells that debt and equity should be mixed to form the capital structure at a justifiable mix, at a certain proportion only. This level should not be crossed. It allows the use of debt up to a certain limit. Beyond that, the cost of equity starts rising. It simply tells that usage of debts, there is no restrictions that debt should not be used, but it is saying if beyond a certain limit, if you increase the quantity of debt in your capital structure, then the cost of equity will start rising. For that, let's discuss the assumptions of this theory. That the assumptions are: the rate of interest on debt remains constant for the certain period. The rate of interest on debt remains constant for certain period. Then point 2, the expected return by the expected rate by the equity shareholders remains constant or increase gradually. Here both the things are there. 2, when the debt is used up to a certain limit, the expected rate of equity shares will be remain constant. But after crossing that limit, the rate of the cost of equity starts rising gradually. Okay. Assumption number 3, the WACC first decreases and then increases. The cost of capital first decreases and then increases. You will understand properly by observing this diagram. Here, it is the central point where the cost of debt is rising. Here, the cost of debt till this proportion, you can use the debt. this on the x-axis here the degree of leverage, and on the y-axis the cost of capital is given. To certain limit, this is the limit that you can use the debt proportion in your capital structure. But if you cross that limits, it will lead to the rise in the cost of equity share capital. Okay, then cost of equity rises at this level. WACC of cost is denoted, and the when the KD is used for a longer for a short period of time to the particular limit, the cost of equity will decrease, and later on it will also increase with the cost of equity. I hope this theory is clear to you. Then Modigliani and Miller approach, Mahamurak approach. Okay, just name is suggested because he said always say in the opposite sense. So I have named it the M for Modigliani and M for Miller. It is Mahamurak approach. Okay, it was given by Franco Modigliani and Miller. Then it is the irrelevancy theory of capital structure. And then it is identical to NOI approach, that it has same feature, that it is irrelevant. So it is, that's why it is said that the identical to NOI approach, the method is identical to NOI, means the whatever we studied in net operating income approach, it's quite similar to some extent as same in the same things are there in Modigliani and Miller approach. Okay, the assumptions are a bit different, but the some at a little extent the things are being said. Here also he says that the value of firm is independent of the capital structure. The value of firm has no impact on the capital structure. Okay, sorry, capital structure is not, the capital structure does not impact the value of the firm. But the value of the firm will be affected by operating profit. Operating profit, I told you many times earlier, that is the EBIT, earning before interest and tax. This influences the capital structure. Sorry, this influences the value of the firm. EBIT impacts value of firm. I hope this is clear now. Then it includes the concept of arbitrage. Concept of arbitrage. Arbitrage means to take risk. Then concept of arbitrage is also there in the Modigliani-Miller approach. And the additional feature of this theory is it is a behavioral justification. There is a behavioral justification in the Modigliani-Miller theory. Let's see the assumptions. Assumptions of this Modigliani-Miller approach are asked n number of times in the previous year exams. So this is very much important. Remember all the assumptions thoroughly. Either it is in dividend theories, or either it is in CAPM or APT model, or in this capital structure theories. Most of the assumptions are the first targeted to ask questions from these topics. Okay. Then assumption number 1, firms are classified into homogeneous risk class. The firms are categorized into homogeneous risk. Then point 2, there are no corporate taxes. No corporate taxes exist. Then point 3, the dividend payout ratio is 100%. The dividend payout ratio is 100% in the capital structure theory of Modigliani-Miller. That is 0% retention. No retention will be done. All the dividend will be paid out. Okay. Then all the investors have similar expectation. All the investors have similar expectation. And point 5 says that there exists a perfect capital market. A perfect capital market exists, which is a myth. Okay. Then point 1, what are the conditions for the existence of perfect capital market? Let's see that point 1 is investors are free to buy or sell the security. Investors are free to buy or sell the securities in the perfect capital market. Then investors behave rationally. The behavior of the investor is rational in nature, means they use logic. Then point 3, they are well informed. They have right to get all the information related to the investment or the capital structure used by the company. Then there is no transaction cost. It is also called as flotation cost. No flotation or no transaction cost will exist in case of the Modigliani-Miller approach. Then point 5 is they borrow funds without any restriction. The investors can borrow funds without any restrictions. I hope these all assumptions are clear, most important from the exam point of view. These assumptions are most important because they are asked in the previous exam too. Let's understand this Modigliani. This is the whole crux form. Here he has given the prepositions. Let me zoom the figure. So let's understand. The theory stated that the value of the firm is not dependent on the. Something is happening. Now it is clear. Okay, I am reading for you because it's quite small. The theory stated that the value of the firm is dependent on the capital, on the choice of the capital structure or the financing decision of the firm. Is not dependent. The value of the firm is not dependent on the choice of the capital structure or the financing decision of the firm. On the contrary, it is affected by its operating income apart from the risk involved in the investment. That its theory, it simply means that we have studied in the previous slide that it is independent of the capital structure. Value of firm is independent of the capital structure and it is affected by operating profit. Okay, then not affected by the risk proportion is also always constant. Then here in further it states that the approaches is derived by Modigliani and Miller during the 1950s. It enables the net, it is resembles the net operating income, means it is identical. Now in quick glance of the assumption, tax rate is 0, then transaction cost is 0, then size of the information access is access to the investor. So here we were tax rate 0, transaction cost 0, then the same information access investors and corporators, and the flotation cost is also 0 and CDT rate is also 0%. Okay, then let's see the proportion. The prepositions given by Modigliani Miller are classified into two ways, that preposition without taxes and preposition with taxes. In the first preposition without taxes, he said that the capital structure does not influence the value of the firm, and the debt holders and the equity shareholders have the same priority. For in the proposition without taxes, he said that the capital structure does not influence the value of the firm, and the second, he said that debt holders and equity shareholders have the priority. In the second prepositions, he said he has again given 2 points, that the financial leverage is directly proportional to the cost of equity. Financial leverage means the debt. Debt is directly proportional to the cost of equity, and with the rise in debt, the cost of equity shareholders perceives higher risk. Whenever the companies will use the more debt, the cost of equity will also rise. Then prepositions with taxes. Here we have seen the preposition without taxes. Now let's see what he has given in the prepositions with taxes. In the preposition with taxes, we have to study the 3 points. In the first point, it assumes the existence of taxes. Therefore, the tax benefit due to the interest payments are recognized. So in the preposition with taxes, he said the tax exists. Earlier, he has given the assumption that there are no taxes, but in the preposition 2, he said that tax exists. Then, so the cost of debt is reduced by interest shields. Interest tax shields reduce the cost of debt. Okay. And the third point, therefore, the change in debt component can affect the value of the firm. The usage of debt will affect the value of the firm. From both the side, he is saying in case of preposition with taxes, the tax will improve. All the things which we have studied in net income approach will be applied. Same in the preposition with taxes, additional point is that he said that tax exists. But in case of preposition without taxes, we have studied two prepositions, that the financial leverage is directly proportionate to the cost of equity, means the usage of debt will result in the rise of equity shareholders, and risk will also be high. And in preposition 1, as related to the capital preposition without taxes, the capital structure has no influence on the value of the firm, and the debt holder and equity holder has the equal priority. I have repeated this twice because I know that this is the most important theory of capital structure, from where question is most priority. There is a highest priority of the question to be asked. Okay. Now let's see a quick glance of net difference between the net income and net operating income. So net, in case of the role of the capital structure, there is a relevance of capital structure in net income approach, and in case of net operating income, there is no relevance of the capital structure. Okay. Then in the degree of leverage and the cost of capital, amount of change in the degree of leverage will alter the WACC. As the debt will rises, it will reduce the WACC. And in the case of net operating income, assumes that the degree of leverage is irrelevant to the cost of capital. That as the debt increases, it will not impact the cost of capital. Okay. Then assumptions we see, there are no taxes, then cost of debt is less than the cost of equity, then debt doesn't change the perception of the investor. But in case of net operating income, cost of capital always constant, cost of capital will always constant, then the value of equity is residual. Then point 3, increasing in the debt increases the expectation of the equity shareholders. I hope these two charts have cleared all the concepts regarding the net income, net operating income, and the Modigliani-Miller approach. So that's all about the capital structure theory. I hope you understood well the concepts and the theories related to the capital structure. We will meet again in next video. Till now, bye and thank you. If you like the video, please hit the like button. Bye.